Most founders think they need a full-time CFO to scale, but hiring one too early can be a very expensive mistake. By the end of this video, you'll understand exactly how a fractional CFO can help scale your business and save hundreds of thousands compared to a full-time hire. I'm Eric, the founder of Adapt CFO. Over the last 14 years, I've helped ambitious founders in tech, healthcare, and services grow from 0 to 3 billion in revenue and exit for over $100 million. I'm going to share 7 key insights about fractional CFO services that most founders discover too late, including exactly what you should expect, what's possible, and how to maximize the relationship. The first point is the strategic partner reality. The role of the new school CFO versus what it used to be, the old school CFO, is that back then it was all based on compliance and taxes and just getting the financials done. Whereas now the new CFO is looking at the future. What we're doing is we're running forecasts and cash flow analysis and improving margins so the business can move forward and grow and ultimately exit at one point. Last December, we got a new client in the professional services industry. I met with her, the CEO of this company, and she presented me with a few issues they were having. Number one, she just went through a partner buyout and her partner left. Also, the margins were not as healthy as they should be. She wasn't getting clear visibility into her financials. So what we did was approached it from a couple different perspectives. One, we needed to unpack the financials and make sure that it's truly accrual. So once we did that, we were able to implement a cash flow forecast to understand exactly if they have enough cash for the buyout. After we really understood what their cash flow looked like, we improved their margins, put more cash flow back into the business, and she was able to buy out her partner just on profits alone. And now fast forward to today, she only has one payment left. The company is healthy and she's able to sleep at night. The second point is the true value of fractional CFO services. There's a big difference between the cost of a full-time CFO and a fractional CFO. Full-time CFO will cost anywhere from $250,000 to $400,000 a year for their salary, and that obviously comes with taxes and benefits and all the other additional costs of a full-time employee. Whereas a fractional CFO, so that cost can be anywhere from $2,500 to roughly $10,000 a month, which annually can be anywhere from 30 grand a year to $120,000 a year. And that is exactly what you'll pay, and there's no fluff around it. Most small businesses don't need a full-time CFO, and if you're looking to get the same value, hire a fractional CFO and you can get the same KPIs delivered, the same cash flow forecasts, you can have a budget created, all of those same processes, procedures, controls, and different aspects that CFO brings, you can get at a fractional cost with the same value for an early stage company. So you can get those same services because you're hiring someone to do tasks for you, and also they'll still think strategically, but they won't have extra time sitting around. And a big time or a full-time CFO typically needs to manage a team. So since they won't have to manage a team, that time is just not needed. Typically, small businesses will hire a lot of generalists and have them wearing multiple hats. But when they wear multiple hats, they're not getting specialists and someone that's able to focus on delivering value. And if you have a full-time person that's not working their true capacity, then you're going to have gaps in different areas. So if you're wondering whether your business is ready for this level of financial strategy, we've developed a free profit and cash analysis. It's a short call where I'll help you improve your gross margin, cash flow, or identify one or more cost inefficiencies. Click the link in the description to book it today. All right, let's get back to what you need to know. The third point is the growth stage reality. So the CFO's work changes between a startup and a scale up and a growth oriented company, because in the early stages, the problems are very different than when you're trying to scale. In the early stages, you're just trying to make sure that the business stays afloat with cash flow. Your books are done so you can file taxes. Whereas in the growth stages, you're really trying to utilize that cash flow to grow the business for marketing efforts and sales, and obviously build a team. Also in the growth stages, companies may want to acquire smaller companies to grow as well through acquisition, and ultimately get to a stage where they want to exit. So exit planning will also come into effect. One story that we have with a client that was in the startup phase in the beginning, whereas later they were in the growth stage. In the beginning, we were really just having some strategy sessions, closing the books, and making sure that the company was staying afloat through fundraising, working with investors. Later on, we were traveling and we were going after new opportunities, partnership ventures, and ultimately getting to a point point where we reinvested the cash back into the business to acquire new companies. Even if you're trying to stay in the same industry, you can invest in companies in different industries and grow not only vertically, but horizontally. The metrics that you'll look at in the early stages versus in a growth stage is, in the early stages, it's more balance sheet oriented, right? You're looking at current ratio, cash, liabilities, and really just understanding what your financial position is. Whereas in the growth stages, you're looking at financial performance and looking at optimizing that performance through the profit and loss statement. You'll look at revenue growth, gross margin, EBITDA, and more importantly, adjusted EBITDA, which a lot of people aren't looking at, but putting those two together later on are key to growing exponentially. The fourth point is when timing is everything. One of the clear signals that your business needs a fractional CFO are lack of growth, lack of visibility into your numbers, and wanting to grow the business, but not knowing where to start. There really is a need for a fractional CFO at every stage, but the question is at what capacity? In the beginning, you may want a fractional CFO, just give you some guidance, whereas later on, you want to look at exit planning, you want to look at optimizing your financials, getting some serious controls in place so you can grow efficiently and not just all over the place. You'll know your business is ready for a fractional CFO when you're unsure about the numbers, you have lack of visibility, and you're at a stuck point. You're not growing like you want to be, or you just need some guidance on what to do with your cash, or your board just tells you what to do. So another startup came to us over 5 years ago. It was clear that they needed a fractional CFO because they were in a cash crunch and they needed additional funding. The fifth point is the all-in-one approach. With our comprehensive approach, we really get our hands dirty. We are both player and coach. And we initially started with the operational budget, and what we were able to do is identify those pain points, go to the vendors to negotiate better costs, keep track of it, and maintain those savings over time. The sixth point is the technology advantage. The tech stack for CFOs is super important in 2024 for many reasons, but primarily for accuracy and efficiency. If your CFO is still in Excel and doing work manually, their work is not going to be accurate because they're having to continuously update items and check it. It's also not going to be efficient for their time because there's a lot of Gen AI tools out there that connect to the financial platforms that allow you to save a lot of time. We're using tech and AI for our clients in a couple different ways, but primarily we're using items like ChatGPT and QuickBooks Online. And ChatGPT allows us to optimize our emails to our clients. It allows us to create formulas or just ask challenging questions that you don't have to ask your manager for. A lot of people aren't aware of it, but QuickBooks Online also has a lot of AI features inside of it, and that saves both our team and our clients time every month. So one way that we're using tech to add more value to our clients is for financial reporting. We use a platform that generates financial reports very easily and allows us to analyze it more. We're not taking too much time trying to generate the reports. So one of the tech platforms that we use acts as kind of a dashboard. So it's automatically updating with our books. So when our accounting team is updating the books constantly and it's connected to that financial reporting platform that we use, our clients can go in and they can see real-time data with pretty graphs that's not just an Excel spreadsheet. So when we pair our clients' data with the technology that we use, real-time data is readily available through a dashboard, and you don't have to go scouring, crunching numbers. It's already there in front of you. The seventh point is maximizing the partnership. So what makes for a successful partnership between a CEO and a fractional CFO is communication. You have to be in sync with each other, knowing what the strategic initiatives are for the organization and allowing this fractional CFO to implement that from a financial perspective. Communication comes with key meetings on a weekly recurring basis or daily, just depending on how big the company is, and also transparency, knowing exactly where each other is. So being able to listen, but also speak the truth and also communicate initiatives and data transparently. If the CEO is not transparent with the CFO, there can be a lot of wrong decisions made. For example, a budget for a new year and there's constantly new costs arriving, we won't know where we're going to end up or how much cash we're going to have. We had a client that was with us for roughly 5 years, and this client was constantly growing the business and killing it, but we could not get a budget implemented. And sometimes the CFO needs to be hard and say, hey, these costs need to be hard coded, and we need to create this budget and implement it throughout the organization, or else we're not going to have control of our finances. So with this client, we became very close over the years, and ultimately we have to give and take. And with that, we finally would get budgets implemented, but we'd have to create an extra bucket so they could pull from for their creative initiatives and strategic partnerships outside and other things that they wanted to chase, but we could still have an operational budget in place for the entire organization. So we just talked about 7 things that founders need to know about working with a fractional CFO. Here's a quick recap. So the first thing we talked about was the old school CFO versus the new school CFO. The second thing was the full-time versus the fractional CFO. And thirdly, we talked about different services for different growth stages. We also talked about knowing when to hire a fractional CFO, and we talked about benefits of using a company with all-in-one services. The other thing we discussed was why your CFO needs to be tech savvy. And lastly, we talked about maximizing communication to get the best partnership. If you want help with any of this, click the link in the description below to schedule your free profit and cash analysis. In the call, I'll find ways to improve your margins, cash flow, or identify one or more cost inefficiencies to help you make more money and build your business.